Chase, good to see you. So I will quickly make sure that we have the chat window organized, and that you guys can chat with each other. And then it's also getting streamed on LinkedIn. So if anybody wants to head over there and okay, chat is activated. You can do that. Hey, Swapnil, good to see you. Ruck, good to see you. Okay, so today, obviously, we are talking about this whole game of finance for entrepreneurs. I'll keep it relatively brief. I think lots of people, at least here from the US, are kind of in holiday mode with 4th of July. Um, but I was thinking to just kind of do a little bit of a private equity 101 type of session to see how that could basically be leveraged for a lot of people that own their business, have their own businesses. I will quickly check this here. All right, I think I can move to this. That should work relatively fine. Okay, so I talked about this a couple of times before, right? So in general, there's this tendency that this whole area of private equity is becoming more and more a target for people that want to that are investing money on the ultra high net worth side. There's obviously this whole private equity industry in general, but in general, there's a lot of money available in the private equity space. It's not really what we want to talk about today as an investment, but what we want to talk about today is you could how you could leverage that trend if you own a business. And I mentioned that on the first call about basically the rules of investing for entrepreneurs. Your skill to create and execute a business strategy that really is profitable is pretty valuable and should basically be seen as an asset that you have. Even if you don't plan to work like for the rest of your life in a business managing and running the business, you should still um, probably leverage that skill. And I also don't really know people that are like full blood entrepreneurs that don't want to leverage that skill later. I might need to take a break, but then very often like some kind of mentorship type of scenario at the least seems to be pretty exciting for most people. Um, so this is just in general a little bit the trend lines. So the especially in the ultra high net worth world, which is like family offices and so on, the tendency is definitely that there's a there's a lot of yeah they're leaning towards private equity more than ever in history, and you can see that with some of the stats that I shared in previous calls. The number of U.S. listed companies is going down at a pretty high pace. I mean, it picked up a little bit um, in the 2020s, but the trend line definitely points down, and the number of private equity backed companies is obviously going up. So and you can see it here in terms of basically money available that can go towards private equity is constantly growing and it's not going to stop growing. So if you own a business or if you own entrepreneurial skills, then I believe that this is something everybody should pay attention to. Okay, so um, and I mentioned that in the last calls, just kind of re-stressing that in the sense that I believe for an entrepreneur who has a profitable business and wants to get out of that kind of grind, the first kind of thing that comes to mind is to sell the business, for example, to a private equity firm or to a strategic acquirer. Um, but that is very often not necessarily the smartest decision, at least not out of my perspective. there will be lots of people that will tell you otherwise just because they're making money with it. But like either the private equity firms that are trying to acquire you, guess what? They're making money with it. Then there are obviously lots of brokers, lots of investment firms that are making money with it. So there's obviously a big push on entrepreneurs that have companies that are working relatively well, that they will get offers, right? But it's obviously also in the nature of the business that there is an arbitrage opportunity for the ones that are acquiring your business on the one side, and the other is there are lots of disadvantages if you just sell your business outright and then get one big paycheck and like the tax implications, all those different things. I mean, there are ways to kind of get that a little bit under control, but this one big paycheck to a person is not necessarily. I think everybody can see that that's not necessarily the smartest way to do it. So, what about this idea with to create a private equity wrapper? First of all, um, a fund structure in general has made a lot of people rich, right? If you're looking at Warren Buffett, Schwartzman, King Griffin, like there's a lot of people on the Forbes richest people in the world list that made their money by owning funds and owning uh, the GP positions and funds, right? So they don't necessarily make the majority of their money with the investments itself. They're making the majority of their money by investing other people's money very well, in a sense, right? So I mean, Jim Simons obviously is most probably the um, most successful in terms of returns. Like I think since 1986, it was a compound annual growth rate of like 77%, which is crazy. Warren Buffett also did well, especially in the first half of his career, but later on it became a little bit tougher. Schwartzman obviously founded Blackstone, very successful, and Ray Dalio. So if you're looking at their funds, their own personal net worth is basically based on the fact that they always get performance. I mean, some of their own money will be in the funds, right? But that's not really how they're making the majority of their money. Their own money has been created by charging fees for basically managing other people's money and investing it in a good way. And I think that there's nothing wrong with that. Like that people get compensated in a good way for making other people money. I don't think that there's anything wrong with that in general. So their personal wealth was basically built um, on the back of the GP positions in the funds that they own. But so in general, I don't think that this is a bad idea in general to follow that model. So how those funds in general structured, right? The funds are in generally structured that you have a management firm, that's normally the GP, right? And that management firm is basically the company that is the brain of the strategy, right? So Ray Dalio, Bridgewater is basically the management firm, and then they have entities which are the funds that you can invest into. Right? In private equity, the general structure is that you get about 2% management fee and 20% carried interest. I'll go a little bit deeper into how that works. You might wonder, okay, do I have my own firm? Why should I wrap it around it? But we'll get a little bit more to the bottom of that, right? And then the second entity in the fund is always the fund itself, right? Which is normally the limited partnership, or where you find the limited partners um, that are in the fund. So the people that are investing into the fund are silent partners, right? They put the money in there, and how the money is going to be invested is at full discretion of the management firm. Right? And the management firm is driving the strategy, and then basically at the same time owns 20% of the fund, right? And that's how the carried interest is getting created, right? So if the fund entity, people put in the money, and the management firm automatically owns 20% of the firm if the structure is 2 and 20. Okay, so that's basically how the carried interest is getting created. So what that also means that with the increased value of the fund, so if you, for example, have a 5 year or 10 year lockup, the NAV, so the net asset value in the company is going up, and the management firm participates in that, right, in that growth. Not necessarily as like financial payments, but they will basically participate in that in that growth. So if you would have like a 20% return, as an example, after 5 years, the fund value would have doubled, and with that, obviously, also the 20% are part of that doubling. Okay, so that entity basically receives the funds of the investors. If you create that wrapper, you might not have an investor at the beginning, but you would probably still have a similar structure in terms of ownership. Okay, and then if you're looking at the flow, it's basically that the management firm executes the strategies on the investments, right? So if you would acquire a firm outright as a fund, the management firm is basically making sure that the investment grows and has a lot of, and very often has a lot of control. It depends on the equity amount that we would buy in the company, but it can obviously be up to over 100%, right? So the management firm basically executes the strategy, but can own up to 100% in whatever investment it is. If it's a company, it's obviously pretty straightforward. You can buy like 20%, 50%, 80%, the whole thing, and depending on that, you will have different amounts of control. In general, private equity firms are very, very good in controlling companies, even from a minority position, because that's what they are specialized in. But sometimes people think if they just sell 20% to a private equity firm, then you still have control over your company. You will see how they actually have contracts, but two, have kind of leverage to start controlling your business relatively fast, right? So that's why that's one of the reasons why I believe it's much smarter if you create your own private equity wrapper, right? Because then you are also the management firm, right? And then I have a couple of ideas around that, but this way, there are a couple of advantages doing that than just straight out selling it to a private equity firm. So the opportunity is obviously in this, right? So if you have a business and that creates like under 1 million in EBITDA, 1.2 million EBITDA, they can still be very profitable businesses, and they can still be very, very well managed businesses. The big problem is the EBITDA multiples are not necessarily that great. And there might be a more updated version. This is not necessarily what you will find exactly today, but it's just to give an idea, right? So if you have a company that is a 5 to 10 million EBITDA company, it's basically worth almost 3 times as much as the under 1 million company in terms of multiples, just because of the fact that it's bigger. Right, so there's some arbitrage in this chart, right? So if you can grow your business to a certain size, all of a sudden, yeah, you can get up to 9.0 times multiples, and that can even be in some spaces that's much higher, right? You would need to look at the industry, and it can go much higher, right? So there's obviously an opportunity in that where you might say, okay, I don't want to sell my business, but I also don't want to completely operate it like and be in the grind as I've been before, or I want to take a little bit more of a advisor role or whatever it is. You still can use your skills and whatever you learn to go and say, okay, what are bolt-on businesses? What are other I don't know, for example, if it's an e-commerce business, you could add like your own manufacturing. In some cases, we have seen that it added like 70-80% in terms of margins, just by not outsourcing production, but basically running the production yourself. So there are a couple of there are lots of things that can be done to basically move you into another bracket, and then based on that bracket, there you have a different bias profile. And this is the arbitrage, obviously, that the private equity firms that want to acquire your company would basically want to leverage, but you could leverage it. You could leverage it yourself. But so if you're looking at, in general, the fee structure, normally the management firm obviously gets 2% management fees, owns 20% of the fund. That's why 20% of the returns go to the management firm, and the fund itself owns 8%. And then you obviously can start either raising money into the fund yourself, get capitalized by firms like ours, Adagio. If the strategy is really good, we're always looking for companies that for new asset managers, emerging asset managers that run really good strategies, and then you could basically run the strategy and bolt on companies with either just leverage. Sometimes you don't even need outside investors. You can just do it with leverage because your core company has enough firepower to support that. And then if the companies that you are acquiring have like good margins as well, then you sometimes don't even need a lot of external cash. You just need some people that might give you some ideas on how to actually get that done, because that's usually not what an entrepreneur who build a business really focuses on, right? So we would maybe just need to sit down and say, okay, so what is the strategy? What are the margins? How can it be optimized? And then you basically go back to this one here and say, okay, so there's not only like an EBITDA multiple that might be the target, but you want to reverse engineer the whole thing from, okay, what are potential private equity firms that are looking to acquire, and besides the EBITDA, what are they exactly looking for? And you reverse engineer basically to build a portfolio in the fund that you might compose that then can be sold as a 10, 25 million EBITDA business, or whatever range that could be brought into. And the big advantage is obviously if it's structured in the way that I described here, or in the way that you see here. If you do a big sale, all of a sudden that sale happens within the fund, right? And it doesn't happen from you as the company owner just selling it and getting a big chunk of money. Now you obviously have all kinds of ways for restructuring the fund, maybe making the fund that now received all these big amount of money. Either you kind of keep doing the same thing because it's working pretty good, or you might also just um, rewrite basically the mandate of the fund and drive it into other products that are creating enough growth and income for you and your family, but it stays in the fund, and this way obviously stays a little bit sheltered in terms of at least individual and private taxes. If you pull money out for your own use, obviously there will always be income. I'm not a tax attorney to kind of give advice on how to do that in the smartest way, but at least the big sale of the company would not happen in a way that you as a company owner, as a person, will all of a sudden get a big check. So you could leverage this whole thing here by of, like, I mean, in general, obviously, if you know how you grew your business, you normally, as an entrepreneur, have a lot of kind of ideas of what to add to it. Maybe just roll up very similar businesses, acquire market share. As I said, the most important thing, if starting a strategy like that, is to understand what the potential buyer might be looking for, and not just build something that you are personally passionate about and just expand it. The personal passion is obviously important to build this whole thing, but once you go into, okay, let's just create a really, really attractive acquisition target. The way that you're looking right now at creating the value and inside your company for the client, all of a sudden, the product that you're basically selling is not the product in your company. The product that you're selling is the company obviously itself, right? And that's the approach that entrepreneurs in general should take, right? An entrepreneur builds companies. That's the product. The company itself delivers services, delivers value, yeah, delivers experiences, all those different things to a certain set of people that is normally your targeted audience or your ideal client profile or whatever you want to call it. But that needs to be honed inside the company, and systematized in a way that the whole company is basically on board, becoming better and better in doing so. And that's basically the job of the entrepreneur, to build that company that is that can do that perpetually without the entrepreneur constantly being present, right? And then very often, obviously, it's there could be, if there would be money available, I haven't seen an entrepreneur who wouldn't have a lot of ideas how he could create more value for the clients and expand. Or the other thing is also, once you're basically expanding, um, you can you obviously also expand into other client profiles, and that also can cost money, and so on, right? So there are different things that all of a sudden can be done. The other thing is obviously also there are ways to get to pull cash out of the fund through the asset base of the fund, so you can borrow against it, and then you would not even take out. You would basically not take out real a real income in a sense. You would basically just borrow against it, and there are different ways. There are different ways to play this whole thing very, very smart. The first decision is obviously, okay, I don't sell my company for in this kind of low bracket down there with a 2 and 3.8 times multiple. Instead, I will basically embed it into a structure like this. Right. So the first thing is obviously the management firm. You don't necessarily need to have a lot of you don't necessarily need to have a lot of money in the fund, but the fund entity would basically own equity in the company as first target. Um, however the fund got to it. So for the first company, you basically control the management firm, and you are also the only LP in the fund. Basically, once you start raising money into it, it obviously you will have LPs in the fund to give you equity money to acquire more companies and so on. Right. So if you would, for example, target if you would target another company as an acquisition, normally you would not do that with 100%, like 100% cash. You would put in whatever, it's a 10 million acquisition. You would put in 3 to 4 million, and the other 6 million would be leverage. I mean, there's up to 90, sometimes 100% leverage in those LBO scenarios. But it should make sense. It should not just be because you can get it, you're using it. It would obviously need to make sense. Some of it makes sense just in terms of getting to the next EBITDA level, and then yeah, you're basically changing the buyer's profile. But the bottom line is those companies should all be profitable, right? And if you can find companies that are not extremely profitable and you can make them profitable pretty fast, that's obviously a perfect scenario, and there's a lot of value that you're creating in that. And that could obviously be some kind of roll up or buy and build strategy. So even if you would say, okay, I will just take a step back and I just grow the business that you have basically been running all your life to a different level, it will obviously help to say, okay, let's take a step back, and it just by doing this exercise, first of all, ownership wise, you have much more flexibility. The second is you can definitely partner on on a structure like that with someone who could come in and just say, okay, let's install like institutional level management, get you out of the grind, and grow that business to a different level, and you would still have basically 100% control over the company because the management firm is owned by you, the equity is owned by the fund that you completely control, and even if you have money in the fund, those people are completely silent, right? So if you then have a private equity firm and you would raise capital, you would not have the problems that you would have. This is another example. If you would say, okay, I just want to get growth capital into my company, this structure might still make sense just because of the idea to protect your company from having people come in and try to control your company from a minority position. So instead of raising the capital into your business itself, you raise it into the PE wrapper, and then you still basically control everything because you're also managing the GP of that fund. So like all the investors are 2, 3 layers removed, which obviously makes it very, very beneficial for the investor. And then it obviously would make sense that there's a strategy somewhat in place for the people that you raise money from, that you say, okay, we're either growing it to a certain level and then have an exit strategy in some way. But um, it's not even one totally necessary. It could still be just this one. It could, in theory, just be this one company that is getting highly expanded. Let's call it that, right? And then once you are at an EBITDA level in this range, then you can still decide if you want to sell it, um, or you could keep growing it, or you could also say, okay, this whole thing is running. It creates a lot of cash, and you're distributing the cash, um, like the profits, into the fund, and then you can see what you're doing with it. If you're reinvesting it, or if you're investing it into something that is very profitable but doesn't require the grind. You have all kinds of options, right? This is the main thing that I like about it, right? So, oh, I'm going backwards. Sorry. So that's the whole idea, right? So the fund, obviously, the management firm is 100% controlling the strategy in the investments. Your own company would be your first investment, and then raise money into it or not, right? But you don't lose control at all. There's obviously a lot of upside and a lot of opportunity in just saying, okay, let's grow it to a different level. The second thing that I wanted to mention is there's definitely makes sense to build wealth also outside of your business. That's something that should happen while you're in the grind as well, but lots of entrepreneurs kind of forget about that in a degree. So there should be some ideas around building wealth outside your business, and in general, my recommendation would be to, especially um, if you're like an entrepreneur and you're in a place basically where you can create a lot of growth yourself within the company. Any investment that you're looking at should be competitive with the growth that you can create yourself. That is just an opinion, but for me, it does not really make sense that if you can create 15, 20, 25, 30, 40% growth rates on a strategy that you can control yourself, that you would invest into vehicles that are not performing anywhere close to that, right? So there are obviously vehicles like I touched on that before. We don't have to talk about that forever. Like the residential income arbitrage strategy, life settlement strategies with 41%. All of them, if you're looking at it, annualized risk is 0%, 2 years lockup period, 0%, 2 years lockup period. I mean, there are lots of vehicles out there that, especially as an entrepreneur, are available because of the accredited investor status that you would have with owning a company and so on. As long as it's somewhat working, they obviously value a private equity strategy here with like 50%. So there are lots of strategies. The way that we obviously always recommend to do it is to go um, into a portfolio like the similar to the Adagio portfolio or something along those lines, or our portfolio where you would basically have the chance to be diversified through a couple of asset managers that are underwritten, but still have those returns, right? And then if you're looking at compound growth rates, it's obviously pretty impressive. This is just an example, right, where the typical kind of portfolio that we create for people that, as an example, there are people that sell their company for like $15 million, and okay, so what to do next with it, right? So I went over that before in some of the calls, but it's obviously just an example. You have those $15 million. You would say, okay, I want to have like 1 million in cash reserves, and by the way, like this in theory could also be the fund putting the money into because now the money's sitting in that member managed LLC that is your fund, and you would basically then decide, okay, you will allocate the money into into something like this, right? It would be an option, right? And there's obviously, in this case, you would say, okay, I want like $90,000 per quarter in income. That goes into fixed income product that we have with 8 plus 2%, and the rest would go into growth product, just to to keep growing the base, right? So I think those are the two things that somehow should be combined, where you say either as a strategy once you really have a big liquidity event, or also during the career to have some way with with a little bit more diversified scenario where some private wealth is getting built constantly, because it obviously feels good to know that those things are in place, um, that if something in the company happens or anything health wise happens or whatever, that there's basically a passive income stream and some growth happening regardless of what happens with the business, right? And then if the business goes well, at some point there might be a really major liquidity event. I mean, if we're going back to this whole thing here, if you have a $5 to $10 million EBITDA company, um, and the multiple uh, is 5 times, as I said, right? Like that would be somewhat in the range of $25 to $50 million. That then need to go somewhere in a way that you can build basically a perpetual income machine for the family that would last over generations, but at the same time have it embedded in a structure that would allow you to navigate um, how much money you're actually privately taking out. Okay, it's not really complicated. It's also not rocket science. It's also not magic. But that is basically the idea. Um, and yeah, I think that was all I had prepared for today. Wanted to keep it short and simple in a way. I know that there are a couple of guys here on the call that are not necessarily entrepreneurs, but also know a bunch. I think this whole topic is very, very interesting. It's also something that most people are not really thinking about. It's always, okay, you own a business, let's sell it, um, or not, but that there is something in between. I think as an exercise, it's very, very valuable for entrepreneurs, also because of the fact that it forces you to work on the business instead of in the business, which is your job anyways, but lots of entrepreneurs are not really good at it, right? They still kind of build the company a little bit around them at the center, and that is good, to grow it, and that's maybe also necessary to grow it. But it's kind of this whole thing of what got you here won't get you there. Once you basically make this transition into, okay, let's wrap a PE structure around it and really work on something bigger, it kind of releases a whole lot, um, yeah, a whole kind of plethora of additional ideas, and I think it, like so far, it has been, it gets people very, very excited to do that. So yeah, that was that from my side. I wish everyone an amazing rest of the 4th of July weekend, and we will be back next week again. I will post links to the webinar. Maybe in the chat, if anybody wants to, also if you're watching on LinkedIn, who would be interested to kind of dive a little deeper into those things in terms of value creation within a structure like that. Just wondering. By Chase, have a good weekend. You could drop some comments into the chat, would be helpful, and otherwise I'll most probably do it anyways. But I always want to do things that people feel, that they really would be interested in. Okay, awesome. Hey Jeff, good to see you. Hope you guys had some good fireworks down in Santa Barbara. Okay, awesome. So yeah, let's head into the weekend, eat some more food. The dog hated it. Yeah, that's always the problem, right? The My kids also don't love it. We watched it from a distance, and everybody was fine. All right, cool. Have a great weekend, and then see you guys next week.